something caught my eye was XLE last week. You can see that has been very, very well correlated to the oil price. So you can see going back to May, those two lines are pretty much sat on top of each other. That's USO in orange, which is the oil ETF, and it's XLE, which is the energy sector. You can see last week it had a big decoupling. We saw XLE drop by about 6%. That was because we had some poor earnings out of the likes of Chevron and Exxon, which are the heavyweights in that sector. But also we got broad de-risking in equities in general. So another reason why stocks that people maybe are owning and hold, they're letting go of those because they're degrossing their books. So we think XLE's got a bit oversold, particularly in relation to USO. So how would we play that? We think the correlation is going to reestablish itself. We don't think this decoupling is something that's going to be permanent. So how would we play it? We're looking for ways to get long XLE, and we're thinking USO maybe as a short against it might actually make a bit of sense. So the way we look at it is the upside calls in USO, you can see they're on the moon up here, right? So any observations of volatility that are these colored dots are much lower than where the current upside vol is trading in USO because it contains a war premium, okay? And that stuff is super pumped above 50 vol, something like that. So what we think you do, the question is, how do you get long XLE? So the way we think to get long XLE, if we look at our vol dashboard, it's landing near bullish risk reversals. Why is it doing that? Because the volatility is more mid-range here, and the spot is oversold on the lower Bollinger Band. So bullish risk reversals are a way to get long XLE. So we think that makes sense. The skew is still for puts, about 180 for puts, which means you're still getting more vol out of selling the downside than the upside, which is not the case when you look at all those commodities like oil and gold that have flipped deeply into call premium. So the fact that the energy stocks have still got put premium makes it relatively attractive to sell puts and buy calls if that's the way you want to go. You can see the vol over the last month is elevated, so it does have risk of falling back down. So therefore, we wouldn't want to be outright long a load of vol, which is why the risk reversal is good because it's a bit more vaguer neutral. Okay, so that's how we're going to potentially get long XLE. And look, if you're going to do this, you've got to size it in a way where you're comfortable taking down the exposure of XLE if you get delivered on the put strike. I always recommend doing that in that sort of size. You don't want to over lever yourself when you're short options. And then if we look at USO, you can see that we've got the vol is much more elevated. The spot is not oversold like XLE. So actually, we're kind of in the sell call spreads territory here. Now, the fact that the skew's at -5, I mean, that is pretty much as high as it gets for calls. Certainly as high as we've seen it for a year and a half. And you can see the curve is inverted in the front end here. So it's basically, and the carry is positive. So it's basically saying that short dated upside is ridiculously expensive relative to how oil is moving, basically. And it contains a lot of vol premium. So this is something that is ripe for selling because it's very, very expensive. Now, we know why it's expensive because it contains some war premium. But the point being is that if you believe that XLE is going to track oil higher and going to have a strong correlation if oil rallies another 15, 20%, and XLE is not just going to ignore it and sell off, then you don't mind selling some upside calls in USO against the fact that you're long XLE. So the trade idea is